Now let's try to spend some time in terms of understanding the credit exposure. Just as a basic definition, probably we might be very clear that in any bilateral transaction or in any OTC derivatives transaction, whatever is the loss one party faces in case the counterparty is defaulting, that particular loss we are calling it as the exposure. But yes, we'll try to understand the clear-cut definition of it, right? How does it look like in a bilateral contract? What do we mean by the closeout amount? How do I compute it? And an interesting thing, how do I really visualize the exposure as a short option position? How do I compute the future exposure? And how do I compare exposure with value at risk, which is one of the most important concepts in the banking space. Now, before I go with even defining exposure, why do we really need to understand exposure? What is the need for it? First of all, every company, every financial institution, with every counterparty, there are credit limits. If that credit limit is breached, the trading with that party is stopped. Now, how do I really know whether my limit is breached or not? That is purely coming with an appropriate computation of the exposure itself. Similarly, now not just the credit limit, but even we want to price the value of the counterparty risk into the pricing of the derivative itself. And that is where we said an element called credit value adjustment, CVA, which is the price for the counterparty risk. So even if I have to compute that, I need to know how much is the exposure. So appropriate computation of the exposure is very much required. And even if I have to hedge it, because unless I know the price of it, I can't do the hedging of it. Similarly, from a regulatory perspective also, for calculating the regulatory capital or even the economic capital, we require a good understanding of the word exposure. And we need to have a proper computation of exposure. Because generally what happens, just as a procedure, let's say the counterparty has defaulted. What is the procedure? You close out all the relevant contracts with the counterparty. You can close out. We have a process of netting, right? So any future contractual payments we are ceasing. The netted amount, whether I owe to the counterparty or I get from the counterparty, I have to really compute that one single value, whether it is net positive or negative. Probably this computation can be done by taking the required collateral. So if I have received the collateral, it's a benefit to me. If I have posted a collateral, even that is increasing the exposure, right? So the net amount after the collateral deduction and addition. Any received collateral, I'll deduct the value from the exposure. Any posted collateral, I'll increase the value to the exposure. So after that, I'll see final net, whether it is positive. If it is positive, means it's actually in favor of the institution. The institution will be receiving money from the counterparty because of the default. But if it is negative, the institution has to pay to the counterparty in case of the counterparty default. So if it is negative, probably I can look at it like this institution has taken a debt from the counterparty. So it is obliged to settle immediately. So which means even though the counterparty has defaulted, there is nothing that this company or this institution has gained out of the default of that particular counterparty, because whatever is the net, it's a negative, which means this institution is liable to pay to that counterparty and it has to make the payment. No gain that it is able to bring out of it. And probably it would have been better if this counterparty had not defaulted. Whereas if the net is coming out to be positive, yes, I will not take up, this company will not take up any future commitment, but whatever is the amount, whatever is the net positive value, it can take it as a claim from the bankruptcy court, from the proceedings of the bankruptcy. It can claim in the seniority level of an unsecured creditor, and it can recover some fraction of it, right? And again, we don't know how much could be recovered, but there is a possibility of recovery of something. But generally in the computation of the exposure, we do not include that recovery percentage, which means probably it is as good as if I don't expect anything to recover. How is this equation working out? In case of positive, I'm not going to get anything, and in case the exposure is negative, I have to pay everything that I am supposed to pay to my counterparty. That is what the exposure is getting defined as. If the value is positive, you are going to get 0, and if it is negative, you are supposed to pay whatever is the amount that came out to be negative. So the definition comes precisely from there for the exposure. The institution loses if the value is positive, but it does not gain if it is negative. So exposure is coming out primarily as the maximum of value comma 0. So it will always be a positive quantity, right? It is either 0 or positive. So it is not going to gain anything if it comes out to be negative, which means it's as good as a 0. So this is the definition of exposure that goes into various pricing and risk management calculations. So probably even if you look at it here, probably I could compute the exposure over different periods of time somewhere like this. It can never be a negative quantity. I'll come back to that slightly later. But just trying to showcase exposure cannot be a negative quantity. And if at all it's a negative quantity, we have a different term called negative exposure. That only would be a negative quantity, but the general word exposure is always a positive one. And this definition is used in pricing as well as risk management calculation. So probably just a pictorial representation. A counterparty has defaulted. So first job is close out all the transactions with the counterparty. Then net the transactions. Find out whether my net is positive or negative. Even account for the collateral depending on whether I have received the collateral or I have deposited the collateral. So received the collateral, reduce the exposure, posted the collateral, increase the exposure. Look at the net. If it is a positive value, I have a claim on the amount that the counterparty owed to me. But if the exposure is or if the net is coming out to be negative, I'm still required to pay something to my counterparty. So there is really no benefit for me if the counterparty has defaulted. Now in this exposure, the very common form is the bilateral, because any of the party can very well default. So which means any of them can really experience losses. Now it is in this context we even use the word negative exposure also from the counterparty, from the defaulted counterparty's perspective. right? Negative exposure is always from the defaulted counterparty's perspective, because from that counterparty's perspective, it's a gain. It's a minimum of value comma 0. If he has defaulted, it's a gain for him. He is not supposed to pay that much amount. So negative exposure is always a kind of a gain to the counterparty, whereas a positive exposure or regular exposure is actually a loss. So that's the reason we even sometimes try to bring in the recovery value. Though in the computation of the exposure, we don't we don't consider the recovery rates. But in case I'm finally looking at my gain or loss, the recovery will really play a role. Because when the exposure is positive, this is the amount that the party is going to lose. But yes, if he is able to recover something, the loss is only the remaining portion of it. So that's the reason, in case the counterparty defaults, probably the loss is going to be this much. Whereas if the institution itself is defaulting, there is a negative exposure that is coming up for that defaulting in counterparty, which will result in a gain. And that negative exposure, I'm trying to multiply it with how much I'm supposed to pay, how much can be recovered by my counterparty, which means if we can recover something, the gain only is to a limited extent for the defaulting counterparty. So we are really looking at these two things while we are doing the final computation of the gain or the loss. That's the reason recovery values are very important in case of multiplying them with the exposure and the negative exposure, traditionally to compute the gain or the loss. Now, closing out. Yes, close out all transactions with the counterparty. The counterparty has defaulted, close out all the transactions. But what should be that settlement amount? What should be that particular amount? That is what we actually call as value. So it is associated with the valuation of all the contracts with the counterparty at the time of default, by including the netting as well as the collateral requirements. Now here there is a lot of scope for manipulation. Probably overvaluation, undervaluation, all kinds of possibilities do come up. Which means there should be proper practices in place which align this value, which align this amount. There is a possibility of huge number of disputes arriving and out of it, as closely as possible to the real value of the contract. There is a requirement for acting in good faith, requirement for using good procedures and practices in terms of doing a valuation, so that the result that comes out is much more really reasonable. Because there will be a lot of disputes, right? Because these things, sometimes every organization wants to have a positive value rather than a negative value. So because of various reasons, there is a very big scope for manipulation in the computation of the closeout amount. So it actually has to take into consideration various elements, including the credit worthiness of the surviving party as well. To what extent they will be in a position to pay what they are supposed to pay. And this entire thing takes a lot of process, so which means there is a huge time delay. And so there will not be any kind of guarantee, though probably there is a good amount that can be decided, but still there is a lot of uncertainty on the precise amount that is owed or precise amount that can be claimed until this closeout amount has been resolved with all the disputes being addressed properly. Just try to see the exposure. It looks like an option, because when I said if the net is positive, the gain, there is a loss. There is a loss. But if the net of all collaterals and everything is negative, there is no gain. Is it not looking like an option position? Because the institution is losing if the overall net exposure is positive. Otherwise, there is no gain. So it's like a pure short option position. Even a short, right, looking at any kind of short option, if at all the short can either gain whatever the premium amount, otherwise he will have to lose. The loss is unlimited, but gain is only limited to the extent of premium. So here also we are even putting it up, right, maximum of value comma 0. This is the exposure. So even from the company's standpoint, right, this is the exposure. But if I look at the gain or loss from this position, it is exactly the minimum of value comma 0. Right? If the exposure is positive, then the loss, right? Okay, let me write it like this. If the exposure is positive, there is a loss of this much. But if the exposure is negative, then there is no gain that is coming out. Right? Here I am not using the word exposure. It's basically the net of all the values of the contract after taking the collateral also into consideration. So the exposure is becoming more and more similar to that of an option payoff. This is the net exposure that is coming out. It's more and more similar to that of option payoff, because even in option payoffs, what is that we are talking of? The maximum of stock price minus the strike price comma 0. So these two are looking more or less one and the same. Maximum of value comma 0, maximum of stock price minus strike price comma 0. So whatever are the key factors that are driving the option? One of the key factors that drive the option pricing is the volatility of the underlying. So here also I will talk about the volatility of the underlying. What is the underlying here? The contracts are the underlying. So what is the volatility of the contract value? The collateral is the underlying. So what is the volatility with respect to the value of the collateral? That will decide whether the net, what is the actual value of the exposure. So exposure can very well be looked at as an option position. So, and we know that the options are very complex to price. We have some pricing formulas like Black-Scholes formula or binomial tree kind of a formula, but they are really complex to price. And generally, options are slightly more simpler, because here there is even more complexity that is coming up. Quantification of a credit exposure for just one simple instrument, I have to use this kind of a process, and think of hundreds of instruments for which I may have to do this similar kind of quantification of the credit exposure. Right? And if it is own default, then it's like a long position. Counterparty defaulting, it's like a short option position. Own defaulting, it's looking like a long option position. Of course, we will not use it as a part of the regulatory or risk management purpose, because if I have taken a long, then probably there is no chance of defaulting. I mean, there is no chance of risk for a long position, right? Long has already paid. So there is no chance of risk associated with a long position. So we'll do it only for pricing, but will not use it for the regulatory or the risk management purpose. Even in a regular case also, the long positions in the options are not exposed to risk, are not, I mean, they have the right to default. So I don't consider their default as the risk. Whereas the short positions, there is a chance that they are going to default and they are obligated if the long really wants to go ahead. Then, looking at the future exposure, even this is required in many cases. Current exposure we know, current valuation of all the positions including the collateral. The only uncertainty that is there is finding out the actual closeout amount. But in case of future exposure, I don't have an exactness. I will actually define it with different levels of probability. Probably if you see here, this is the current exposure which is known with certainty. But for the future, we have simulated. We have simulated the future exposure by using various mechanisms. And that is from there, we arrived at different possibilities of the future exposure. So which means I will be defining it either in the form of a distribution or a probability association to it. So what may happen in the future? It could be this much future exposure, this much, any of these numbers are very much possible. It purely depends on how all the market variables which are underlying the collateral, right? Collateral value, how it is going to move in future, the contractual values, how they are going to move in future based on the various underlying variables fluctuating, all the contractual features, how they are going to behave in the future, all those will determine what could be the future exposure. So which means I will always look at the future exposure in terms of what is the value and what is the uncertainty that is associated with it. What is the fluctuation or the volatility that is associated with it. And we all need to understand the quantification of this exposure is an extremely complex exercise where in real world I have to do it over longer periods of time because there could be contracts which could be 10-year contracts also, and I have to quantify this exposure even over the 10-year period, which is a very complex process that is used. And every point the values of all the collaterals have to be understood. How the collateral values change in the future needs to be understood. The netting process, it's just not for one single exposure that I am trying to compute. It's again, once I compute the value for one of the instruments, I have to net them across at different points in time, and each of the collaterals could be influenced by different market variables. So the different market variables may change differently, so which means in case of future, quantifying the exposure is a very painstaking kind of an activity. And one interesting thing in this session is exposure, comparing it with the value at risk. It says that both of them have a similarity. Both of them have a similarity because even in case of exposure, we talk about the computation of the worst possible value, how much the company can lose in case the counterparty has defaulted. And generally the exposure also we do it in terms of probabilistic terms. We'll see it in the later sessions, but we'll say, okay, 95% exposure, 99% exposure. So that is also something that is going as a part of value at risk computation. We talk about it, okay, on a time, there is a time horizon that we talk about it, a daily exposure, 10-day exposure, weekly exposure, monthly exposure. So there is a lot of similarity between the value at risk as well as exposure. But at the same time, it is very clearly evident that exposure is much more complex compared to value at risk. There are a few areas where there is a significant difference that is existing between the exposure and value at risk. Look at the time horizon. Yes, both of them use time horizon, right? But in general, in case of value at risk, we that to market value at risk, let's say I'm computing a 10-day value at risk. That's it. Which means I'm computing the value at risk for a very small time horizon. But here, and that too it's a one value. Whereas here I have to find it over multiple time horizons. Right? Probably 1 year later, what is the exposure? 5 years later, what is the exposure? 10 years later, what is going to be the exposure? Because there could be contracts for different kinds of maturities and expiration dates associated with one single counterparty. And I have to compute all those exposures. Right? So I have to fully understand the impact of time and the various specifics of the underlying contracts. Then within that, I'm looking at the aging of different kinds of transactions, because some contracts would be expiring in another 2 months, whereas some of them would be expiring in 2 years, and some of them after 10 years. And every transaction, I have to understand what all the future contractual payments are there, how they are going to change, when they are going to be exercised, the cancellations, which means there is a lot of path dependency. Exposure of one date is dependent on the exposure of the previous date. Right? So that is one major reason it becomes very, very complex in terms of pricing or finding out the exposure in case rather than computation of VAR, because value at risk is a one-time computation, a single value which I am computing at one point in time. I am not taking it as a path dependent calculation. So that's one major place where the VAR computation is becoming looking like much simpler compared to that of computing the exposure. And two, when I'm looking at very long term horizon, various market variables like interest rates, exchange rates, lot of market variables, they can move drastically. Their volatilities can move drastically. Their correlations can move drastically. So apart from the volatility part, even the drift also can come into picture when I am looking at the computation of exposure. But in case of VAR, we generally ignore the drift term because the time period is very small. So in an essence, the VAR we compute it for very short term, right? If I have to simplify it, VAR is generally computed for a short term period, whereas the exposure I am trying to compute it over a long term period. So because I am computing the exposure over a long term, the market variables will have drift, volatility, correlation. All of them could change drastically with the time. Whereas in case of VAR, I only focus on volatility and correlation changes. I need not bother about the drift. Then one more dimension that comes out is in case of VAR, I really don't need to bother about the path dependency because I am not doing it over multiple time horizons. Whereas in case of exposure, I am very much bothered about the path dependency. The exposure on one period depends on the event defined at a previous date. So there is a dependency with respect to the previous. So slightly complicated. Then application wise also, yes, value at risk is purely for the risk management. But exposure, we do it both for risk management as well as pricing, which means I really require two different sets of computations. The pricing also uses the word exposure, which is the maximum of value comma 0. It's just not the risk management world using this definition. even the pricing perspective, we have to use it, which means we need to take the exposure as an input into two different sets of calculations. And even the risk mitigants, right? All these, whether it is netting, collateral, or any other additional termination events, or readjustments, resets, all these things, which are the different forms of risk mitigant, their impact needs to be considered. If at all I have to come out with a future exposure better. Along with that, relevant legal agreements also need to be understood. The type of collateral, right? What are the different types, whether it is a security or cash, or what is that type of collateral? How is it going to fluctuate in the future? When is it going to be received? Right? All these things create more and more complexity. What are the termination agreements that are there? All the different forms of breakouts. Also, are there any walkaway features? All these things will really create an impact into the computation of into the proper computation of the future exposure. So lots of subjectivity can come up, whereas in case of value at risk, all these things are literally not much required because everything is computed as of today. So the computation of exposure is much more complex than the computation of value at risk. And on one side, we even see exposure is only one part of the counterparty risk. So the computation of that itself is becoming a very tedious exercise. So that's where you could see valuing and pricing of the counterparty risk is a very, very time-taking, stress-prone kind of an exercise. So just before we conclude, I think we have spent a decent amount of time in terms of understanding or defining what an exposure is, right? A bilateral exposure. What do we mean by the closeout amount? How do I consider exposure as a short option position? What do I mean by the future exposure? How do I compute it? And how do I try bringing out comparisons between the exposure and value at risk? Right? I hope all these concepts are more and more clear to you. All right. In this session, we'll try to compute the different kinds of metrics for credit exposure. Right? What are the different things? How do I compute expected exposure? How do I compute expected positive exposure? Right? Negative exposure, expected negative exposure. So there are different kinds of computation: effective, expected, positive exposure. So there are different such kind of computations that are required. What do we mean by each one of them is something which we are dealing here. So we will go with how do I compute the expected future value. What do I mean by potential future exposure? What do I mean by expected exposure? These all, remember, they are to do with the future exposure, because current exposure to a large extent we might compute, and even in the current exposure also, uh, though the procedure is more or less fair enough, the expected future or probably a future exposure computation becomes more and more tedious. Expected exposure and future exposure, potential future exposure in case of a normal distribution, how do I compute it? What do I mean by maximum potential future exposure? Expected positive exposure. Then what is negative exposure? Then we are looking at effective expected. So you see, E's and P's, they are very widely used in various forms. So we really need to be very comfortable in terms of differentiating each of these elements and doing the computations accordingly. Now, when we talk about the expected future value, whatever is my netting set, I am looking at, which is netting set is nothing but all the contracts taken as one single set for the netting purposes. I am looking at the expected value at a future time point. Here we are all more bothered about the future exposures because current exposure is very easy for us to compute. Whereas in the future, I am trying to see what would be the value of this contract, what would be the net value of this entire set of contracts at a future point. That is what I am calling as the expected future value. And we try to compute it per different time points. So let's say if this is today, the same thing I will compute per, okay, 1 month from now, 2 months from now, up to 10 years from now. For different time point, we are trying to compute what could be the expected future value at some point in the future. And it's a very important component because during this period, various market variables can change. It's just not an adjustment. It's just not a simple adjustment for time value of money. The future value here is not a simple adjustment of time value of money because various underlying variables can change in various fashions. And why do you think that number would be drastically different from current value? First thing is the cash flows differentials. There is a lot of asymmetry in various derivative transactions payoff. Try to visualize this. Probably let's look at an interest rate swap, right? Where every period there is a fixed interest that is paid by one party and the floating is what is paid by the other party. Now, if I assume just for the time's sake that the interest rate curve is an upward sloping kind of a curve. The interest term structure of interest rates is upward sloping. If that's the case, probably I expect that the floating rates are going to increase in the future, which means in the initial period, but the fixed rate, whatever we have come out, it is arrived at by taking all these expected future rates into consideration. So even virtually, if I am visualizing it as a plain average, it may so look like the fixed rate is much higher in the initial periods compared to the floating rate. So which means the fixed payer is ending up paying much more in the initial periods compared to the floating rate payer. So which means at any point in time the fixed rate payer, because there is a heavy payment that has been done, there is a positive value that is getting created for the fixed payer in the intermediate periods, because he would be receiving much more in the future because he has already paid a lot in by now. So in future his receipts will be much more compared to that of a floating payer. That is where we see an asymmetry. Right? Like this, every swap transaction will see some kind of an asymmetry in some form or the other. So which means you see that the net will be a positive value to some party at some point in time. So in general, for the fixed payer, the net will be a positive, and as it progresses for a couple of periods, the net can keep increasing also. The positive net can keep increasing. Now this is where there is an expectation among the institutions that in the future the value is going to be significantly above or below the current one because of the difference in the cash flows, which means the exposure will differ quite heavily from that of the current. So the future value will not be the same as the current value because of one aspect which is driven by the difference in the cash flows. And the second is with respect to the rates. Okay, today the interest rate could be R, but in the future it might be R1, and that too we are talking of very long-term contracts. So compared to the spot variables, the future variables could differ quite drastically, which means there is a possibility of drift also being added instead of just looking at the volatility and correlation between the variables. If it is for short term, we generally ignore the drift component of that variable. We majorly focus on the volatility and the correlation aspects of it only. But if I am looking at it more from a long term standpoint, there is a possibility of the drift in the future. Either the value will be constantly up or constantly down compared to the present, which means if I am using that particular number in the future, all the calculations will be impacted accordingly. So not even looking at the impact of volatility, along with the volatility, there is a full-fledged change that can come in the expected value of that variable also. That is one more reason we see that the future values will be to a large extent different from the present value, and that's the reason even we really need to have a procedure to compute the future values. And even the collaterals, there could be a one-way CSAs kind of stuff where the asymmetry is coming because it is more in favorable of the collateral receiver and acts completely against the collateral giver. So which means the future value can be higher or lower based on the unfavorable. If the collateral values or collateral terms are unfavorable to a particular party, the future values will be much higher because right now the collateral this party would have paid a very heavy collateral. So in the future, I may expect the value to be much higher. But if the collateral terms are designed favorable to the party, which means it might have received a very high amount today, means in the future it must return back a very high amount, which means the future values would be much lower. So those are one of the reasons we see that the current value of the netted set will be entirely different from the expected future value of the set. And in this context, we do a few computations. Potential future exposure. Yes, future exposure from the current, what did we do? We are doing some kind of simulations, and based on the different simulations that we have got into, we have got different kinds of possibilities for the future. Now the future is going to be anywhere between this and this. Now let's say if I am trying to take that as a distribution, this is the distribution of the future exposure. In many cases it is positive, and in a few cases I am seeing that this is the net value. The net value of the contracts. Here all it is positive, here it is negative. But first of all, for us, only if it is positive, we'll call it as exposure. Right? Negative, because there is no possibility of a gain, the negatives we generally exclude from the definition of exposure, though we'll include them as a part of another definition called negative exposure. But whenever we are defining the word exposure, we are more and more bothered only about the positive terms. Now, whenever we talk about the potential future exposure, it is this at some confidence level. The word potential future exposure is always defined at some level of confidence, 99% confidence, 99.5% confidence. So it is always defined at some level of confidence. So the same future exposure related graph, future expected future. This graph is about the expected future value graph. So expected future value graph, I'm looking at the distribution, and I'm looking at the exposure at certain point at a certain confidence level. So we are looking at a worst exposure which we can have at certain future time. So this is exactly defined on the same lines as value at risk, because what we are saying here, the exposure that would be exceeded with a probability of no more than 1%. There is a 1% chance that the exposure will be more than this particular number. That is what we are calling as a potential future exposure. So to a large extent, there are resemblances between potential future exposure and value at risk, because even when I say 99% value at risk, it means there is a 1% chance that a loss on a particular security or a portfolio will cross, there will be more than this VAR amount. Similarly, in case of potential future exposure, I am saying there is a 1% chance that the exposure will be greater than the PFP. So more or less you see lot of similarities with respect to value at risk, but the only difference is now potential future exposure, I have to define it for many future dates, right? Probably 1 month later, what is the PFP? 5 months later, what is the PFP? 1 year later, what could be the PFP? So for different time points in the future, I am trying to find out what is the PFP. Whereas per VAR, I just need to find out at the current point in time. And the other difference is, actually we are trying to measure the positives. The positive netted amount is what we are calling as exposure. Whereas in case of VAR, the losses is what we are trying to look at. That's again a difference. Actually this is a gain, but I'm not getting it. That's where I'm converting it into a loss. Right? Potential future exposure is more to do with a gain. My contract's position is positive. That is what is going as a part of potential future exposure. Whereas in case of VAR computation, I am looking more from the losses perspective. And probably it's very clear that the potential future exposure is purely from a risk management perspective. And within this context, one more thing that is of very much use for us is finding out the expected exposure. Now we know that only this grayed out portion is what we call as exposure, right? Because we know that exposure is nothing but the maximum of value comma 0. So exposure will only be positive. In some cases, the value of my contracts, the net value, when I say value here, it is the net value of the contracts, net value of the contracts in the future after adjusting for the movements in collaterals and nettings and everything. Now, that particular value, only if it is positive, I'll treat it as exposure. Now what we are saying is, across this positive side, if I am taking the average, that is what I am calling as the expected exposure. So all the exposures which are generally positive, the average of them is giving me the expected exposure. And it's a very important thing as a part of the pricing of the counterparty risk. Right? It's very important as a part of the pricing of the counterparty risk, because expected value, apart from, so in a risk management, we are using the potential future exposure, whereas in terms of pricing of the counterparty risk, we'll use the expected exposure very heavily. And just a point which we have already discussed, only positive values will be included as a part of the exposure, and even any negative value comes, we treat that contribution to the exposure to be 0. And so which means we'll always see that the expected exposure is always greater than the expected future value. Because expected future value we are always looking at it. It could be negative, it could be positive, expected future value could be anything, right? Whereas when I'm talking of expected exposure, I'm taking the average only of the positive terms, which means this number will always be greater than this number, because this number could even include the negatives also. So expected exposure will always be greater than the expected future value, and we know that the expected exposure is sensitive to standard deviation, because the shape of the curve will keep changing. So if the volatility is much higher, probably I see the expected exposure will be higher, even the potential future exposure also will be higher. So the higher is the volatility or the standard deviation of the underlying contracts or the underlying collaterals, we see that the expected exposure also will be much higher, right? Alright, let's look at this situation. Let's take up how do I really compute these two things, right? Potential future exposure. If at all I see the future value, if I define it as a normal distribution, so the future value is going to come out in this kind of a shape. The mean is around 2 and the standard deviation is also around 2. So probably this is 1 standard deviation, 2 standard deviation, 3 standard deviation, minus 1 standard deviation, minus 2 standard deviations, minus 3 standard deviation. Right, now I want to find out in this case what is the potential future exposure at 99% confidence level. Right, I want to find out what is the potential future exposure at 99% confidence level. Alright, let's try it out. Right, what could be? So that's where there are some formulas that are directly available for us. Mean plus standard deviation times the cumulative standard normal distribution inverse associated with the confidence level. So 99% confidence level. Let's try to take these things. That's what will give us a better understanding. Okay, I'll talk about mean, which is mu, or probably let me call it as mean itself, which is 2. Then I'll talk about the standard deviation, even that is given as 2. Fair enough? And then for this I really want to find out my expected exposure, right? So I'm more interested in finding out the 99% confidence interval. Let me try finding out the potential future exposure here. How much will I get? Mean plus sigma times the standard deviation times the phi inverse of alpha. So I'll take it as standard normal distribution inverse associated with alpha. So I'll take it as confidence level. Let me take it as 99%. So here I am getting the potential future exposure as mean plus standard deviation times the standard normal inverse associated with a confidence level of 99%. So it is saying that the potential future exposure in this case is 6.65. Right, potential future exposure I can directly compute as mean plus sigma times the phi inverse of alpha. So here this number, the 99%, because this is a 1 standard deviation, 2 standard deviations. I am looking at 99% confidence interval, which actually comes out as 2.33 standard deviation, and that is what is working out to 6.65. Now, when I am looking at expected exposure, I am actually taking the average of all this positive side. This entire thing is what I am taking as the average. I will be ignoring anything that is below 0 here. So I'll be ignoring this part, but rest of it I will be computing as a part of expected exposure. That's the reason the formula of that comes out as mu times phi of mu by sigma. Okay, now I require the standard normal value associated with mu by sigma. So we do a mean by standard deviation as one calculation. I'll take it as mean by standard deviation. Okay, this is the mean by standard deviation, and I'll compute the capital phi is the cumulative, whereas the small phi is the density function. Okay, so phi capital is what I am looking at. Phi of mean by standard deviation. Right, let me write it as phi of mean by standard deviation, which comes out to me as, I'll take it as norms dist associated with this comma, I set it as cumulative distribution function, so I'll get it as 0.84, and at the same time, so mu times that value plus sigma times, I'll have to take it as the small phi. Small phi times m by s. Here I'll take it as small phi. Small phi times m by s is coming out as the same norms dist. It's not cumulative now. For the same one, I will not take it as cumulative. I'll take it as density function. So the density function here comes out. Okay, well, what is the density function for a normal distribution? We know it is 1 by root 2 pi sigma squared e to the power of minus half x minus mu by sigma whole square. But this is a standard normal distribution, which means what is the density function? Mean will be 0, standard deviation will be 1, which means it becomes 1 by root 2 pi e to the power of minus half x squared. Right, for a particular value, this is what I get it as the normal density function. So the density function that is associated with 1, it is saying that that particular density function, probably even I should be able to do the computation like this. Even I should get the same answer. Let's check it out. 1 by square root of 2 pi. Right, 1 by square root of 2 pi times e to the power of minus 0.5 times x squared. So it comes out to be the same. So I can directly depend on the usage of this particular formula itself. So this entire calculation goes into the density function formula. So which means from here I should be able to compute the expected exposure now. What is the expected exposure? Mu times, this is mu times, I am looking at it as capital phi of mu by sigma, which is this much, plus standard deviation times small phi of mu by sigma. Right, as a capital phi of that, small phi of that, which is giving me that the expected exposure is somewhere around 2.16. So in this case, for that 99% confidence interval, I see that my PFE is somewhere around 6.65, and the expected exposure is somewhere around this. Now let's say I really want to do a graph for this, right? Just a graphical plot. I'll try to consider the different values. Let's say let me start considering, right, different values on this right. Let me start considering the different values on this curve. So let me start looking at right from minus 40 with a difference of, let's say, 1, minus 40, minus 39. I'm looking at mean minus some number of standard deviations. So even mean plus some number of standard deviations. So I'll go with some positives here. Let's try generating the graph between minus 40 to plus 40. Right, let me, oh sorry, there is something wrong that has gone in. Okay, minus, alright, so this formula, if I replicate it, what's happening? Alright, so let's say if I've taken this, so these are the different numbers that have worked out, right? These are my minus 40, minus 39. Let's say this I have taken up to, I'll take it only up to 40. There is no point in doing it for so many large number of values. So from minus 40 to plus 40, let me try looking at the density function for across. Now what is my density function as per my computation? I will go with norm inverse because I did not convert it into standard normal. I'll take it as norm distribution. Let's say corresponding to this minus 40 with the mean being around 2, standard mean being around 2, comma standard deviation being around 2, and I don't want it cumulative, so I'll go for a density function. So I have the probability density function across all these coming out to be something like this, right? Now what I generally want to do is I'll do a simple scatter plot with this, right? And in another way, okay, let me do the scatter plot first by plotting this on the x-axis and this on the y-axis. Alright, so I'm doing a scatter plot, a smooth scatter plot like this. Alright, but here let me include the selection of the data myself, wherein I'll consider, I'm calling this as a density. My x values were from here to here. These are my x values. Okay, let me delete whatever is there. My x values are from here to here, my x-axis values, and my y-axis values are from here to here, right? So this happens to be my x-axis and this happens to be my y-axis, and what I could very clearly see is there is a very clear-cut normal distribution, normal function that has typically come out here. Fair enough. Now in this chart, I really want to add up my potential future exposure as well as expected exposure. So expected exposure is like a simple straight line, right? So the best thing for me to do that is, okay, I'll take up expected exposure, right? I'll take up the expected exposure. What is that I want to look at? I'll take the values twice. Okay, this is the expected, or probably let me take it this side, or here itself. Expected exposure, I'll take it 2 times. Similarly, potential future exposure also I'll take it 2 times. Why? Just for the graphing purpose. Then what I typically do is, I'll even take from where to where. I want it from 0 to the maximum. So I want this plot from 0 to maximum in the vertical axis. So generally I'll take the limits for the graph. In the minimum side I'll take it as 0, but on the maximum side I'll take it as the maximum of this list. So which will tell me that I have to plot this from 0 to almost 0.2. Now what I'll do is, on this itself I will add one more chart, which I call it, let's say, as expected exposure, in which my x-axis values will be these two, right? I'll take my x-axis values as these two, which means it will go from 2.16 and 2.16 only. But on the y-axis, I'll have one point which is 0, I'll have another point which is 2.19, which will directly give me a kind of a line. So at my expected exposure, there is a line that is getting plotted. At around 2 point something, there is a line that is coming up. Similarly, I can do the same exercise with respect to my potential future exposure also. I am plotting one more plot where I am taking potential future exposure, 2 instances on the x-axis and these on the y, which will tell me that my potential future exposure is coming somewhere here. So to make things much more clearer, let me try to omit some portions from the graph where the numbers are much weird. Let me take up to 3 or 4 or 5 standard, let's say up to 15, right? To make graph look much better, I'll take, let's say, only up to okay, I have deleted much more. Okay, probably I could have done the plotting only from minus 15 to plus 15. Okay, let me instead of this minus 15 to plus 15 itself, rest all let me take it out to make the graph look much better. So now this graph is looking much better. I am seeing the range between minus 15 to plus 15, and probably this is where my expected exposure is coming. This is where my potential future exposure is coming up. Now this is one more which I can work out. Let me start changing the standard deviation now. Let me change it from 2 to 4. Suddenly I see that my potential future exposure has gone to 11.3, which has changed quite drastically. But at the same time, even the expected exposure also has gone up. Earlier it was around 2.16. Now it has gone to 2.79, which means as the standard deviation is increasing, both potential future exposure as well as the expected exposure, both of them are going to change. So this is one thing which we have to be comfortable with. A graphical way of understanding is much better for us. So this is what is the point that is corresponding to the expected expected exposure, and this is what is the point that is corresponding to the potential future exposure, right? Now the next thing that comes out for me is the maximum PFE, which is nothing but the peak. Now this is where I am trying to do the potential future exposure across time. This is at one point in time, right? Probably at some date. On some date, this is the potential future exposure. Let's say 11.3 is the potential future exposure on some date. Now, what we are talking of is, I'm looking at the maximum PFE. So, we are doing it at different time points. Okay, let's say this is the PFE after 1 month. I'll find it after 2 months, after 3 months, after 10 months, after 20 months, after 5 years. So, across different time points, I'm plotting the PFE. And just looking at what is that maximum PFE. That is what we call as the maximum PFE or peak potential, or we can talk of it as peak potential future exposure. So it's a kind of a worst case exposure across the entire time interval, right? Then, okay, now I have the worst exposure in that time interval. I am also interested in what is the average exposure in that entire time. What is the average exposure across that entire time, which is what we are calling as the expected positive exposure. Now probably it is like this. Let's say I have taken the expected exposures. Now we know what is expected exposure, which is the average of all the positive exposures, exposures at a point in time. That is what we are calling as expected exposure. Now what we are saying is, I am computing this expected exposure at every 1 by 24th of a year, which means every fortnight. Look at it like I am computing the expected exposure every fortnight, and because I am taking it every fortnight, at the time period I am taking it as 1 by 24th of a year. So for each of the period, right from 0 to 1, which means across 1 year, for different time periods, I have observed what is the expected exposure. Now if I am simply plotting this expected exposure, right, on this smooth scatter plot, if I am plotting this expected exposure, what is that I am getting? Okay, across these different time points, I am getting the expected exposure to be something around this. So this is how the expected exposure is coming out for me. Now on this, I really want to know what is my expected positive exposure. Expected positive exposure is nothing but these are the expected exposures across all the periods. So it is the average of the exposure across all the time. Right, so I'm looking at the weighted average of the expected exposures across all the time periods. So which means I can very well take it as the average of the exposures across all time periods, which is coming out to 0.305, and expected positive exposure is going to be something. So I have to take the average across all the points, means the expected positive exposure is going to be constant for this entire period. So if I am trying to plot this chart again with expected positive exposure, again I'll have the same set on the x-axis, but on the y-axis I'm taking the expected positive exposure, which is very much coming out to be a horizontal line. So this is the expected positive exposure, and I am really looking at it as a loan equivalent because it looks like on an average this is the amount of loan that is lent to the counterparty. So this comes out to be the expected positive exposure. So I am taking the average values of all the expected exposures across the entire time period. And this is a very important piece for doing the pricing and also in terms of assessing the portfolio counterparty risk. So that's the reason we really do this kind of computation. And what we also see is, to a large extent in that same numerical, in that same numerical, if I have to find out the expected positive exposure, it says I can take it as 0.27 times. This is the derivation that comes out of it. Right? I can take it as 0.27 times sigma t to the power of half. So I can take it as 0.27 times sigma, which is the standard deviation. So if this standard deviation is annual, even my t should be annual. So t is 1 year in this case. So over a 1 year period, I can expect that the expected positive exposure for this kind of example is around 1.08. But at the same time, if I am doing it over a 2-year period, my expected positive exposure is going to be somewhere around 1.52. So that's the way out in terms of computing the expected positive exposure. And if I have computed the data at different points in time, this is what is the computation for the expected positive exposure. Then similarly, I'll take the negative exposure, which is exactly opposite of the positive exposure. All the future values are taken as negative, which is looked at purely from a counterparty's perspective. So just like the way we have found out expected exposure, we call it as negative expected exposure. So probably the negative of these numbers is what is going to be the negative expected exposure. And at the same time, just like the way we have done expected positive exposure, which is the average of all the expected exposures over time, I'll take the average of all the negative expected exposures over time and I'll call it as expected negative exposure. Then apart from that, we have a couple of more calculations like the effective expected and effective expected positive exposures. Because we know that these two, for short dated transactions, it has been observed that they underestimate the exposure because they do not take care of proper rollover risk and they generally give an underestimation of the exposure. That's the reason we go with effective expected exposure. What do we say in effective expected exposure? It is the non-decreasing portion of the expected exposure, which means, see, expected exposure here, all it is growing. So as long as it is growing, I'll take the positive value. But if it is going down, I'll take this only. I'll not consider the decreasing portion at all. So only the increasing portion of the effect of the expected exposure is what I am calling as effective expected exposure, which means in the first case, okay, for the first period I'll take it as it is, but from the second period I'll do a comparison, or probably I'll take it as the maximum of whatever is the effective exposure of that particular period or the effective expected exposure of the previous period. Because for the first period, both of them might be the same. But after that, I am simply looking at the maximum between these two. So which means if the current expected exposure is higher than the effective expected exposure of the previous period, I'll take the current value. Otherwise, I'll retain the previous period value itself. Which means I could see that, okay, as long as it is increasing, I am getting an increasing value. Now here I could see after a certain point, right, after a certain point I see up to 0.62 the expected exposure has been growing, but after that it has fallen for a few periods. Though it has raised after that, but it did not rise more than the previous point. So all this I'll consider the effective expected exposure to be the positive, the highest value itself. Now in this period it was 0.75, which was higher than the previous. So it is coming out to be this much here. So like that, the falling periods are traditionally not considered as a part of effective expected exposure. Now if I am doing the graphing for that, effective expected exposure, wherein again I will consider the same here, whereas on the y-axis I'm going to consider these numbers, the effective expected exposures. I see that there is a kind of a stepwise. Okay, up to here it was increasing. After that it was flat. Again it increased. Again it became flat. So this is the non-decreasing portion of the expected exposure. And in this context, we also bring in one more, which is the effective expected positive exposure. Effective expected positive exposure. These are more and more appropriate for short dated transactions because it is seen that the effective exposure and effective positive, the expected exposure and expected positive exposure, they are underestimating the exposure for short dated transactions. So effective expected positive exposure is nothing but the average of the expected exposure during this period. Effective expected exposure during this period comes out to effective expected positive exposure, which is generally coming out to effective expected positive exposure whose x values are going to be the same but whose y value is going to be the effective expected positive exposure. So these are the four different kinds of numbers that we are very much looking at. So approximately this is assuming that all the maturity transactions are getting replaced. All the short term ones are getting rolled over. And that is what is the exposures that I am considering in these aspects. We don't need to get too much into the mathematics of these calculations. Even if we are able to remember the formulas for the same, it would be more and more effective. So in summary, what we have looked at here is understanding of what I mean by expected future value, potential future exposure. Then I have computed the expected exposure, and if at all my distribution is a normal distribution, how do I get into finding out the expected exposure and the potential future exposure? What do I mean by the potential future, maximum potential future exposure? Then how do I find out the expected positive exposure, right? And finally the negative expected exposure, and finally the words effective expected positive exposures. Now a little bit of confusion can very much exist because different E's mean different things. In some cases it is effective, in some cases it is expected, in some cases it is exposure. Similarly, the P's, there is positive in some cases, there is potential in some cases. So we have to be slightly comfortable in terms of using the nomenclature more and more effectively. All right. Now let's try to talk about the different types of factors that will drive the credit exposure, wherein we'll spend some time in terms of seeing how the credit exposure looks like for loans, bonds kind of instruments. How does the credit exposure looks for simple future in uncertainties like forward contracts or probably a plain vanilla options? How does the future uncertainty look like? Or how do I look at the future uncertainty or the future exposure for those instruments where periodic cash flows are there, like swaps? And how does it look like if I am combining two or more different kinds of financial contracts or a combined financial contract? How would the exposure for that look like? And wherever there is some kind of optionality in a contract, like a swaption, how would I look at the exposure for that? And in case of credit derivatives like credit default swap, how will I look at the exposure? So basically, in a nutshell, this entire thing is about different kinds of financial instruments and how would I typically look at the exposure with respect to that each of the financial instruments. How does it change over time? Over the lifetime of the contract, how would the exposure change in all these elements? So first of all, looking at the bonds. First thing is they are probably the simplest of the instruments. to a large extent, I see that the exposure is deterministic, which is generally equal to the face value of the bond, or probably the amount of loan that has been given. So the amount which is at loss, the amount of exposure, to a large extent it is determined with certainty. There is very little uncertainty that is surrounding that, and generally equal to the notional value either of the loan or of the bond. But in case of bonds, additional uncertainty is because of the market rate, interest rate fluctuations, right? Interest rate fluctuations, probably there is a small difference in the value of the bond. If the interest rate fluctuate very heavily, then probably the difference is significant. But if the interest rate volatility is much lesser, then probably the impact is much lesser, because generally it pays a fixed rate coupon, but in the market the interest rates, let's say they keep changing. So if the interest rate falls, probably the price of the bond is going up, which means the exposure is also increasing, and vice versa. That's the only uncertainty that is present. Whereas even in case of let's say the traditional loans or any bonds, especially more applicable to the loans, even though I give it as a floating rate loan, right? If I am giving it as a floating rate loan, even this problem will not occur, because this problem is coming up only because generally majority of the bonds pay on a fixed rate basis. But in loans, if I am giving the loan on a floating rate basis, even this kind of an exposure problem will not come, because the reset is going to happen at every periodic interval. But there the uncertainty is more and more about the prepayment, because prepayment feature is enabled with many loans. So wherever the prepayment is possible, that uncertainty will get added up to the exposure. So in a simple thing to understand, instruments like loans and bonds, the exposure computation is fairly simpler. Correct? Okay. Now let's look at how do I look at the future uncertainty for a straightforward transactions like forwards. How can I really look at the uncertainty in case of a forward contract? Generally, we look at it as an increasing function of time. That's it. I look at it as an increasing function of time. So the exposure in majority of the cases for forwards and vanilla options. Why vanilla option? The moment I have paid a premium, the exposure is more or less the same. Right? If I am talking about a plain vanilla European option, once I have paid the premium to the counterparty, after that the exposure is more or less the same, just like a forward. So that's the reason I am looking at the exposure being the same, which is proportional to the square root of the time period in case of forwards as well as plain vanilla options. So as time passes, the uncertainty keeps increasing, right? Because it's a proportional only to the square root of t. And we have to understand here, the maturity of the contract does not influence the exposure at all, right? It does not influence the exposure at all. It's simply the exposure is proportional to the square root of time. And if at all there are many exotic options where the payoffs are completely different and they are more and more path dependent in some of the cases, probably for those kind of options the exposure computation is more and more difficult. But exclusively for plain vanilla option, the exposure is directly proportional to the square root of t. Now let's take one example. Let's say for this, I want to look at a forex forward, 5 years forex forward. So let me look at the time, right? Let me take every quarter. So 0, right? I'll add up 0.25 in each of the cases. So let me take it up to 5 years. Alright, 9.25 and probably 10, up to 10 I'll take. So this is the time I want to look at the exposure, right? I'm doing the calculation of the exposure, or probably PFE. Let me take it as the PFE in case of, let's say, the forex forward. Let's say I have a forex forward whose volatility is around 8%, and I want to find it out at 95% confidence level. So here I'll try to omit the drift, which means I can look at the exposure here, which is a proportion of time period T. So because I want to look at it with a 95% confidence level, I'll take it as norms inverse associated with 95%, right? I'll take norms inverse associated with 95%, multiply it with forex volatility, and then I would multiply it with the square root of time period. So this is very much working out to be the volatility or the exposure that is associated with the forex forward alone. So these are the exposures that are associated with the forex forward. So what I'll simply do is I can plot a small chart now again, wherein I'll select, okay, the forex forward. I'll look at the exposure for this, wherein I'll take these numbers on the x-axis and I'll take these numbers on the y-axis. So this gives me the exposure with respect to the forex forwards, which I am seeing that it is increasing with respect to time, right? This is increasing with respect to time. So that's how we look at for any kind of forwards, or for that matter any kind of vanilla options. Now the next part that I have to look at is, how do I look at the exposure with those securities which have periodic cash flows like swaps? Probably if I look at interest rate swap, there is some kind of a payment that happens, let's say, every quarter. So, and in some cases, what could very well happen is, probably with an interest rate swap itself, we could see the fixed rate payer, right? We have discussed this already. The fixed rate payer, in the initial period he may end up paying more and more, and in the later periods he may end up paying lesser compared to the floating rate. Because if I assume that the term structure of the interest rates is upward sloping, it is expected that the floating rates are going to go up in the future. But a fixed rate should pay a fixed amount. So what we generally see is, in the initial period, the fixed rate payer pays much more compared to the floating rate payer, which means in the future he is going to receive more compared to the payment. So the present value of the future cash flows is going to be much positive for a fixed payer, under the assumption that the interest rates are upward sloping, right? So there is a possibility of the reversing the effect of future uncertainty. Now it may be the case that the fixed payer is paying much more, but in the future he may be paying much lesser, which means in these kind of instruments we see that the exposure is proportional to T minus T times the square root of T. So the time to maturity, T minus T, is still the time to maturity and the time that has elapsed. So both of them will play an important role when we are trying to find out the exposure with respect to those instruments where periodic payments are there. For a single payment forwards and plain vanilla swaps, plain vanilla options, we have seen that this is not an impacting factor. So there is a balancing out here between the future uncertainties along with the rolling of the swap payments across time. That's the reason there is a dependency on T minus T. So which means in the initial period I see that it is increasing purely because of square root of T, right? Because this may not change that much. So it is increasing because of square root of T as T is increasing, but as we move closer and closer to maturity, this value goes much lesser. So because of that we see this value is going to go down. Now probably if I look at the same, in the same probably if I am looking at this is the interest rate volatility. Let's say I want to look at an interest rate swap. The same diagram with respect to an interest rate swap. I want to look at it with 95% confidence interval, so the confidence level, so that's where I am taking norms inverse 95% multiplied by whatever is the volatility of the interest rates, and I multiply that with T minus T into square root of T. So here T is 10 years for me, T minus T into square root of T. This is what I will be looking at in terms of finding the exposure with respect to the interest rate swap. Now in the same diagram, let's say I want to look out for the exposure with respect to the interest rate swap. So here I will consider the interest rate swap, wherein again on the x-axis I am considering the years, whereas on the y-axis I am looking at the exposure coming out of the interest rate swap. Now this is resulting in a kind of a falling, so which means up to a certain point I see that the interest rate swap is higher, and after that it is the exposure is higher, and after that it is falling. So even in the numbers you could see, okay, it is going up. From here it started falling down, it has come to the extent of 0. And what we see is the maximum. Now I can find out the maximum value for this, right? So at t equal to t by 3, probably I find the maxima value t minus t times square root of t. I can do the differentiation and find out where the maximum is going to occur, right? So I could really see t minus t, the differentiation, the derivative of square root of t is 1 by 2 root t plus square root of t times minus 1. This is equal to 0, right? This is what is going to come out. T minus t times 1 by 2 root t plus square root of t times minus 1 equal to 0 to find out the maximum. So it is working out like t minus t times 1 by 2 root t is equal to root t. So t minus t is coming out to 2t, t is coming out to 3t. So small t is coming out to t by 3. At t by 3, at 1/3 of its lifetime, so somewhere at around 3 years, I could see the maximum value is bound to occur, 3.33 years. Right, so around 3.33 years, that is where I could see that the maximum is occurring. So the longer is the maturity period, if it is a 10-year period here, the lifetime is much higher, more number of payments are swapped, which means there is a higher risk that is coming up. Right, instead of 10 years, if I look out for 20-year period, I'll see that the numbers will be much more different. Right, instead of 10-year period, I look out for a 20-year period. Probably in this example itself, just to look at, instead of 10, I make it to 20, I'll get the exposure much higher than 0.16. I'm getting the exposure even to the extent of 0.4s, 0.45. So there is an exposure which is much higher rather than in the earlier case. So the maturity is more longer, the lifetime is higher, more number of payments coming up, resulting in a higher risk. And now when we are looking at the exposure, we see that the exposure will keep changing with the nature of the cash flows. In some cases, what could very well happen is the frequency of payment could be much faster. Probably the payments could happen on a quarterly basis, but the receipts could happen on a half yearly basis. Now that is the specific nature of the cash flows. In that case, the exposure will obviously differ, right? I have to be really careful understanding when the cash flows are really occurring, because in case of basis swap, we see that the payments are more and more frequent than the receipts. So in that case, the risk is much more, which means the exposure also will be much higher, right? So because in a few months the payments will not be, the receipts will not be there at all, the payment only will be there, which means the exposure could be much more higher in those kind of scenarios. And even how well I am able to project my cash flows, that is purely based on the shape of the yield curve. If it is upward sloping, okay, in the initial period the fixed payments are much lesser, much higher, because the floating payments are much lesser. So that will create a very heavy positive exposure for the fixed payer, because the forward value of the swap is much more positive in that case. So this is what we could see even in the diagrams. As the exposure is getting higher and as the number of years is getting higher and higher, we see that the graph is becoming more and more wider, the exposure is increasing, right? With the years to maturity, the exposure is increasing. And what we could also see is, in case of interest rate swap, at somewhere in the middle, or probably at somewhere at T/3, the exposure is maximum. It goes up and keeps coming down over time. And whereas in case of forward, I have seen that it is only a matter of square root of T. And the forward value of the swap is primarily whatever is going to be the value in terms of the future. It looks more or less flatter. Then in some cases I may be required to combine these two profiles. Probably let me think of combining a forex forward with an interest rate swap. What is that that's going to come out? Can I call it as a currency swap? Because currency swap, I look at it as a combination of an interest rate swap and a forex forward. So probably I may think of combining these two, right? I may think of combining these two and probably call it as a currency swap, right? In a currency swap, I am looking at two parts. One, okay, the forex separately, which is purely based on the volatility of the forex, which we have already discussed. The volatility, the sigma of the forex, if there are more and more longer maturities, then the volatility could be much higher there. And if there are final exchanges of the notional, even that is exposed to forex risk. So in your currency swap, one depending on the maturities, two depending on the volatility, and three depending on the exchange of the notional, these are all subjected to forex related risk. Along with the interest rate swap exposure, I am looking at the forex forward exposure, and I am combining the two even with the correlation between them. So probably if I am looking at the currency swap, actually I have to compute the variances here, right? So what I'll typically do is I'll take the norms inverse, the confidence interval I'll still keep it as it is, but now instead of directly looking at the standard deviation and multiplying it with the appropriate formula, what I'll typically look at is variances. Variance of the first one. Okay, what is the variance of the first one? For the forex forward, the variance is square root of t, the square of it is t, times, right? Instead of square root of t, I am taking it as t times the forex volatility squared, sigma squared, plus again t times, so we did square root of t into t minus t. So this is square root of t. T minus t I have to do it as a square. T minus t I am doing it as a square, and I am talking about the interest rate volatility. Right, I am talking about the interest rate volatility. Plus, I have to consider the correlation between those two. 2 times, okay, what is I have to consider the covariance. So, for the covariances, first of all, I am taking the multiplier, which is the square root of t times again square root of t. So, in both the multiplying 2 square root of t's, I could have directly taken t, and I will take 10 minus t, right, and at the same time I have to look at the volatilities of both of them. So I will take the interest rate volatility multiplied by forex volatility, and I have to multiply that with the correlation that is existing between them. So this is the entire calculation that is working out to compute the correlation for each. Right, I am looking at the cross currency swap here. Something has gone wrong. Square root of t times this squared. Okay, here also I require this squared. Yes. Now, based on the correlation between the two, I am getting this to be these to be the value, which means if I try plotting out this particular element on the graph for a cross currency swap, right, for a currency swap here, if I am taking my x to be somewhere in between this and my x to be somewhere in between this and my y values to be in between this. So it is very much coming out for me that in case of cross currency swap, I am looking at a behavior which is somewhere in between these two, and it is going higher and higher. And depending on the correlation, I could see a different kind of a figure. Probably you see here more or less a similar kind of a picture is coming out. Correlation between the two interest rates and the forex rate is an important driver here. Now if I change the correlation, I see that the computations are differing, the gaps are widening, and if I am looking at, let's say, minus 0.5%, the gap is even more widening. So correlation plays a very important role in the process. And longer maturity swaps are having more risk. We have already discussed it due to the greater number of interest rate payments that are happening on the swap. Then the next important point to understand here is optionality. So basically like an instrument like swaption, where it behaves like a swap and there is an option to exit out of the swap in the beginning. So it's an exercise decision which is creating a complexity. And generally what we look at is, in case of swaption, okay, this is the period of option and this is the period of swap. And parallelly for the same period, if I am looking at the forward, what we generally observe is, for the swaption, until the period of exercise, the exposure is much higher. You could see this light colored line. The exposure is higher until the time of exercise, because I have paid a premium and there is a good chance that my counterparty will default on it. So that extra premium that I have paid, wherein there is a chance of exercising that option, this is where the value, the exposure will be much higher. In case of forward, there is nothing that has been paid. So the difference is, after that, under the assumption that the exercise will happen, this is the additional exposure that is coming up. Whereas once the expiry period, exercise period is over, I'll see a reversal in the trend. Because there could be, in some scenarios, probably here if you look at it, okay, let's say this is the today's price. Now I am looking at trying to model the different possibilities of future exposure. Now there could be some possibility that this is the exposure in the future, but the one path that it may take is this, one path it may take is this. Now if it has taken this path, probably it would have got exercised. But if it has taken this path, there is a good chance that the option would not have got exercised. So because there are some paths which are leading to the same exposure, wherein the option would not have got exercised, now this is where the value of the swaption is actually going down. The exposure on the swaption is going down compared to that of the forward. So a very important point for us to understand here is, in case of wherever option like features are there, up to the point of expiry, the exposure is much higher. But from the point of expiry till the maturity date, we see that the exposure will keep coming down and down. This is the example there. And especially for instruments like credit derivatives, probably assessing the exposure is a very heavy, complicated task. I have to really look at the wrong way risk. What is the correlation, especially in credit default swaps? The major problem is the wrong way risk, correlation between the defaulting party and the collateral that has been given. And they are very hard to characterize. There are different discrete payoffs. Even in a credit default swap, probably this party will keep paying the premiums every year, but only but when the default event has occurred, default of the reference entity has occurred, there is a lump sum payment that is going to come up. So especially if you just look at a single named CDS, initially the exposure is much higher because I am keeping on paying the premium, but probably no settlement is happening. So CDS premium is getting wider and wider, and this is where the exposure is much higher in the earlier stages. But the maximum comes when the reference entity is actually experiencing a credit event, because I need to receive the benefit or the payoff from that party where the default has actually occurred, because I require an immediate payment. So at that point in time, the exposure will be much higher. So modeling all these things will become a real complicated and a challenging task. So what we generally see is, with respect to credit derivatives, finding out the exposure requires a lot of modeling activity, considering various parameters into a consideration, and that's what makes the process more and more difficult. So overall, we have seen for different kinds of financial instruments, how do we really calculate the exposure? We have looked at the loans, bonds, which are simpler to find the exposure, more or less deterministic. Whereas slowly moved on the complexity lane, looking at the forex forwards and any forward rate agreements, forward contracts, along with plain vanilla options. Then slowly moving forward into multiple cash flows kind of instruments like swaps, a combination which includes a swap plus a forward like currency swaps. Then what if we look at with an option related instruments like swaptions, how does the exposure be computed there? And finally, in case of credit derivatives, what is the kind of difficulty that comes in terms of computing the exposure? So all these things need to be understood with utmost comfort level. All right. Now let's try to understand the impact of netting on the exposure. We know for different kinds of financial instruments, different kinds of exposure calculation mechanisms are there. So now I want to see in quite a good number of OTC derivative contracts and with different kinds of counterparties, we see netting is a very common phenomenon. So I am trying to see what is the impact of netting. How will netting play a role in terms of decreasing the exposure? In what cases netting can decrease the exposure and in what cases it really does not impact the exposure at all? And can we relate something between correlation and netting? And is there any kind of a relation between the absolute value of the exposure and netting? So three major topics. One, in general netting. Two, correlation between the various exposures. Does it play any role in the netting? Three, the absolute value of the different exposures. Does it play any role in the case of netting? Okay, first thing, the conceptual side of netting. First of all, it allows the future values of the trade to offset each other. A better diagram here. Let's say I have a contract 1. With these are the values at different points in time. Right, I am expecting these to be the values at different points in time. Probably let me call these as the exposures at different points in time, or probably let me not call them as exposure because there is a negative value as well. So the value of the contract at different points in time. So the exposure is only the positive part of it. So this is the one. Similarly, I have a second contract wherein this is the positive part of the value, which means this would be the exposure. Now, if the netting had not been there, when these two contracts are being executed, I see that the exposure is the simple summation of the positive parts only. This is the total exposure there. Agreed? Fair enough. Now, the next thing which I am trying to look at is, in case netting is allowed. In case netting is not allowed, the exposures are getting added. This exposure I am adding up with this exposure. So exposures are getting added, which means the positions, though they are exactly opposite positions, they are not offsetting each other. Whereas when netting is allowed, first of all, there is a netting set that is defined. So let's say here the contract 1 and contract 2, I call them as a part of the netting set. Within that netting set, the values are added, not the exposures. Values are added. Means the positive and the negative becoming 0. Negative and a positive becoming 0. So the values are added here, and after that the net exposure is being taken. Now that's the reason here after adding up the values, these two are offsetting each other, which means the net exposure is becoming 0. So that is what is the impact of netting on the future exposure. If netting has not been there, this would have been the exposure. Because of the netting, the exposure has actually come down. And is there any impact of correlation with respect to netting? Now, if I look at the correlation between the future values and the exposures, right? So let's say the correlation between the two future values is high. It's very high chance that both of them will be of the same side, which means they are not going to offset each other. So that there is no netting benefit that is going to come up. Let's look at this example here. Let me look at, okay, probably I'll create a scenario here. 25, 15, 15, 5, 5, 5, minus 5, minus 15, minus 15, minus 25. Let me talk about this being the, let's say these are the trade 1 and trade 2, right? These are the future values of these two. Now let me see what is the correlation that is existing between them, just for the sake of understanding. Right, let me take 25, 15. Then I'll look at 15, 5, 5, 5, or probably I'll call it as, let me take it as 5 minus 5 otherwise. Okay, one of them, let me take it 5 minus 5, minus 5 minus 15, and then I have minus 15 minus 25. Right, let's say these are the ones. Now if I take the correlation between the exposures, these two exposures, the correlation between these two is very much close to 1. Right, the correlation between these two exposures is 1, which means they are very much running in the same direction. They are moving in the same direction. Now let's look at the exposure now. Right, the positives. So the netting, without netting, between them, what is the exposure? Because these two are positive, right? Because these two are positive, the netting is 40 here. Without netting, the total exposure is 40, and here it is 20. Here it is, okay, because I have taken this as minus 5. Here it is only it is 5, and here it is 0, because both of them are negative, the exposure is 0. And here also, because both of them are negative, the exposure is 0. Right? So without netting, these are the exposures. So 65 and divided by 5, I am getting 13 as the expected exposure. Now let's assume now the netting benefit is there. Now if the netting is there, right, positives and negatives will offset, but here there is nothing. 40, 15 and 5 still 20. Only this part is offsetted, so this will become 0, and even this part is out, I mean 0 only, here it is 0, so the expected exposure is 12. So overall the netting benefit, here I am not getting any, only 5 is coming here, 0, 0, which means the netting benefit is only 1. Because the correlation between these two is very high positive, I see that the netting benefit is very minute. Right? The netting benefit is very minute. That is one thing. On the other side, look at this situation. Right? If I am looking at the same situation wherein I have a trade 3 now, let's say the trade 3 is like this: minus 15, minus 5, 5, 15, 25. Right? Minus 15, minus 5, 5, 15, 25. Now what happens to the correlation between these two? The correlation between this and this, I see that it is close to minus 1, a very negative. Now if it is very close to minus 1, what is the netting benefit here? Without netting, these are the exposures, because in this case 25, in this case 15, because negatives will not be counted, only positives will be added. So here it is 10, here it is 15, here it is 25. So this is the overall exposure, and the average expected exposure is 80. Now if netting is there, I'll first add these values. 25 minus 15, 10. Because it is positive, I'll take 10. 15 minus 5, 10. 5 plus 5, 10. Minus 5 plus 15, 10. Minus 15 plus 25, 10. So the average expected exposure is also 10, which means there is a benefit of 8. So the benefit is much higher if the correlation is much lesser between the future values. That's one important point that is coming up. Between the future values, if the correlation is high and positive, the future values are expected to be of the same sign, so the netting is literally not much beneficial. Only when you are looking at them with opposite signs, you see here, in many cases we see that the exposures are with opposite sign. That is where the netting is really providing a very good benefit. And the highly correlated, we saw in plus 1, the netting benefit was only 1, whereas in case of minus 1, the netting benefit was plus 8. So when they are highly correlated, the netting benefit is the least and it happens the reverse, right? So if they are identical distributions, if the correlation is very, very close to 1, we see that the netting benefit does not come in at all. Only the size of the transaction increases. The netting benefit does not come out at all. Probably in this case, the best way for me to understand that is increase both the transactions by 5. Right? Increase all of them by 5. Okay. So this values I'll increase by 5. So these are the numbers. Similarly, increase this by 5 as well. What is happening to the correlation now? Between them, the correlation is still 1. Now look at what is without netting. What are the stuff? So I can look at only the positives to be added. So maximum of this comma 0 plus maximum of this comma 0. This is what I would be adding without a netting. Okay, without. This is without netting. Now with netting, I'll simply compute maximum of this plus this 30 plus 20 comma 0. This is what is coming with respect to netting. Now you see where is the netting benefit? Netting benefit, even that 0 is even that minimum of 1 does not exist, right? So netting benefit, if I look at, in this case it is literally 0. In all the cases it's 0. So the expected netting benefit, which is the average expected exposure in terms of netting benefit, is simply 0. But if they are negatively correlated, I see that the netting benefit will become more and more stronger. And wherever there is a perfect negative correlation, I can maximize the netting benefit. That's one positive point that we have to understand. And majority of the netting occurs across the different instruments, across the different asset classes, where I really perceive that the correlation between them is going to be much, much lesser. And this is where we even try computing what is called as a netting factor. There is a computation which we do with respect to the netting factor to talk about whether there is a netting benefit or no netting benefit, or by what extent the netting is bringing down the exposure, right? If there is a netting benefit versus no netting benefit, just to see by how much extent the exposure after netting. So probably this is nothing but exposure after netting versus exposure before netting. So it gives me, is netting really bringing down the exposure or not? That is what we are calling as a netting factor. So it is purely based on the average correlation between the various assets, and n is the number of assets. Now let's assume that the correlation is 1, perfectly positively correlated. Now what is the netting factor that is coming out? Let's say I am talking of 5 different assets. 5 plus 5 into 5 minus 1, 4, and average correlation, they are all perfectly positive correlated, so which means 1, and this I am dividing it by 5. So numerator is becoming square root of 25 divided by 5, which is 1. So the netting factor is 1, means net to gross. Before, after netting, by before netting is 1. Both of them are one and the same, means there is no netting benefit. Netting benefit is 0 if there is a 100% correlation, if the correlation between the various asset classes is 1. But if I have to see that the netting factor is much lesser, so if I want to make the netting factor to be 0, What should be the case? This in the same formula, if this has to be 0, so I should get it as n plus n into n minus 1 row, average row should be equal to 0. So n into n minus 1 row bar should be equal to minus n. So it is coming out that the row bar should be equal to minus 1 by n minus 1 or probably 1 by 1 minus n. Right? If the correlation between average correlation between the various assets is around 1 by n minus 1, then there is a 100% benefit because the net exposure is becoming 0. And in some cases, if the correlation, if there are, so this is a negative value. If you see, n is always higher, so 1 minus n is a negative value. So this will always be a negative. But if the average correlation is 0, means if all the assets are independent, what would be the number there? This part will become 0. N into n minus 1 into rho bar will become 0. So the numerator is square root of n, denominator is n, 1 by square root of n. So overall netting factor for the exposure is around 1 by square root of n. So these are some of the things with respect to the netting that we have to be comfortable with. Then the other side that I am looking at is, apart from the netting, wherein the correlation of the future values we have looked at, but I also need to look at the relative offset of the future values from 0. Now if I have to look at the same, probably let me look at these two examples. Minus 20, minus 25, minus 15, minus 15, this. So there are trade 1 and trade 2. Right? Now look at the netting benefit. Right? Now let's look at the netting. Without netting, 25, 15, 5, 0, 0. With netting, this is 5. This is still negative, so 0. This is still negative, 0. Still negative, 0, 0. So overall, the netting wise exposure is 1, which means the netting benefit, expected netting benefit that I am getting is around 8. Now look at the correlation here. Okay, that's an interesting part. Minus 20 and then 25. Minus 25 and then 15. Minus 15 and then 5, minus 15 and minus 5, minus 25 and minus 15. Very important statement here. Look at the correlation between these two. What I could see is correlation is 0. Even though the correlation is 0, I am able to get a very high netting benefit. The reason being, all of them of trade 1, they are negatives. So this is one more point. So I have to look at the correlation between the future values as well as the correlation between the exposures also. Here, if I look at the correlation between the exposures, it could be much different. And one simple point for me to understand is, if all the individual trades are having a negative value, it will definitely create a netting benefit. Irrespective of whatever the correlation that is existing between the future values, it is very well expected to provide a netting benefit for me. Similarly, you look at the other side, if both of them are positive, if all the values are positive, okay, without netting, 60, 40, right, this is 25 because this is negative, I will not count it, 15 and 5. So the expected netting, without netting, the expected exposure is 29. But with netting, okay, add it up, 60, 40, but here it becomes 20, here it becomes 0, and here it is 0. So overall, the expected exposure is only 24, means there is a netting benefit, which means even if all the values are positive also, there is a possibility of some kind of netting benefit, which means not just the correlation between the two, I also really need to see by how much they are offset from zero. All the future values by how much they are offset from zero, even that is where I am looking at the absolute values, and even that is going to contribute to the reduction in the exposure. So that is where we are focusing more on understanding the impact of netting on the future exposure, how correlation plays a role with respect to netting, and how the absolute values of the offsetting of the future values from zero also plays a role in terms of the exposure. All right. Now let's try to understand the impact of collateral on the credit exposure. How do I really compute the credit exposure while collateral is present? Because now we know if netting benefits are there, netting is done, what is the process to compute the credit exposure? Now I am trying to find out if collateral is there, how do I compute the credit exposure? The first thing is computing how much is the value of the collateral. Trying to understand the margin period of risk, will define it, and we'll see how it plays a role on the credit exposure. Impact of collateral on the exposure, whether it goes up or goes down, and how do we really differentiate the collateral for repos versus collateral versus other OTC derivatives, and how does it play a role with respect to over collateralization. Now, just to compute how much is the collateral, that is what will be either added or subtracted with respect to the credit exposure. So for that, if I have to know how much is the collateral, lot of things with respect to collateral we are quite comfortable and familiar with. We know that if I take more and more collateral, there is an operational cost into it. There is a lot of liquidity requirement because I may not be, there are various other risks that are typically coming up of the collateral posting. And at the same time, all these things, how much collateral I have to really collect is guided by various other stuff like thresholds, the minimum transfer amount, etc. Now, if I have to really compute the amount, simple. All the independent amounts, the mark-to-market values. First of all, compute the mark-to-market value of the trade. For each of the trades, compute the mark-to-market value. And to that, because here I need to get the netted, post the netting. Post the netting, compute the mark-to-market value of the trade. If you have set up any kind of independent amount, irrespective of whatever is the mark-to-market value, just add that up, because this independent amount is something which is over and above and it is equal to the negative threshold. So it's better I add it up. Now that is the first step, right? Any specified independent amount, I compute the mark-to-market value of the entire netted position and I add it up. Because the independent amount is actually increasing the exposure because I have collected that independent amount. Right? So, I mean, I have to collect that much of independent amount. So, if I have paid the independent amount, that is the exposure that is coming out. Now, the required collateral comes out as, okay, the mark-to-market value of the trade if it is positive minus the threshold, because up to threshold I cannot take any kind of collateral, right? I cannot take any kind of a collateral. So I am looking at the threshold with respect to the institution. For me, what is the collateral? And V is the market value of the trade. So for the whatever is the threshold that I have posted, that is what I am taking out. Right, so the maximum of V minus whatever the threshold that I have posted, comma 0, minus the maximum of whatever is the minus V. Minus V is from the counterparty's perspective. So for counterparty, the exposure is minus V, minus whatever the threshold that is expected out of the counterparty, which is what we are subtracting. So the maximum of these two minus the collateral that has already been collected earlier. If some collateral is already being collected, only on the top of it is what I have to compute what should be the threshold. Now, which means if this value comes out to be positive, if I have already collected a very high collateral amount, this overall value will come out to be negative, because corresponding to my threshold, if the value is much higher, I'll collect. Corresponding to my counterparty's threshold, if the value is more negative, I have to pay it back. Right? By that much amount, the collateral has to come down. So that's the reason I look out for more and more collateral if it is positive, and if it is negative means I am supposed to return back. Either I have to make a collateral payment or I have to return back the original. So I'll look out whether the value of the amount is above the minimum transfer amount. So if it is above, then probably make the payment. If it is below, I'm not making any kind of a call. So just let's look at as an example. Okay, there is a threshold on both sides. Let's say for 100,000 bucks or 1 million. Minimum transfer amount is 100,000. The rounding is 25,000. Every 25,000 the rounding is happening. The portfolio value is this much and the collateral right now held is 0. Now what is the collateral requirement there, going with that kind of a logic? The collateral required, right now I am talking about, okay, the portfolio value 1750 minus 858 minus the institution's collateral, my threshold. I am setting the threshold at 100,000 or probably no 1 million. So this much is the collateral, minus, assume that my counterparty does not have any kind of a threshold. It's a one-way CSA. Let me even make it clear. Probably if it is a one-way CSA, my counterparty does not have any. If that's the case, the second term, maximum of minus V minus whatever is the threshold, this part is 0, minus the collateral that I am already holding. So overall, it is coming out to 754,858. Right? This is the amount of collateral that I have to hold. Now this 754, because I am rounding it to the 25,000. First of all, I'll check whether it is greater than the minimum transfer amount. Yes, it is greater than the minimum transfer amount, which means I have to ask for a collateral. Now that I have to ask for a collateral, whenever the asking for a collateral is happening, whenever the requesting for a collateral is happening, then generally it is a rounding up. And I have to round it up to the nearest to 25,000, which means it's not 750. I have to round it up to the 775,000. So 775,000 will be the collateral that would be deposited, that would be requested from the counterparty, and that would be held. Now, assume that the collateral is deposited now. The counterparty has deposited the collateral, and after that the portfolio value goes to 1.623 million. What will happen now? Now look at it. Now what is the collateral now? Maximum of 1,623,920 minus the threshold 1 million. And from the counterparty's perspective, it is 0. And the collateral that is already held is 775,000. So this is becoming 623,920 minus 775,000. Right? Whatever it is, there is a negative value. Okay, probably here it is 0, here it is 8 and a 0. Then 77, so minus 151,080. So now, because I have to refund, now I have to see whether it is the absolute value is more than the MTA. If that's the case, I have to make a refund. And if I am making a refund, generally when I am paying, I'll try to look at the rounding down of it. So rounding down is taking it that I will make a refund of 150,000, making it to the rounding to the nearest. I'm making, so now that I am rounding down, I am actually refunding 150,000. So that's how the transactions keep moving. So this is the process in terms of the determination of the collateral. This numerical should help us in doing the determination of the collateral quite comfortably. Now the same logic, probably a complicated can happen if at all there is a threshold requirement by my counterparty also. Then the next point that I have to look at here is the margin period of risk. We have already looked at earlier. When I say margin period of risk, it's a time that by the time I have actually asked my counterparty to deposit a collateral, I have given a collateral call, to the time he actually delivers that collateral and I receive the collateral. The time gap here is what we are calling as the margin period of risk, which means during this period I'm not having the collateral. I did not receive the collateral. So which means any increase in exposure during this period, that increase in exposure is completely uncollateralized. I am exposed to risk during this period. The collateral receiver is going to have an additional risk during this period. So, if I have to understand the concept of collateral better, even this margin period of risk, how the exposure changes, how is the exposure going to vary during this period, how many days is it going to take, how is the exposure going to change during this period, that entire thing I have to really understand. Generally, we see 4 or 5 major areas where the collateral process can actually be slowed down. There are 4 or 5 important stages as a part of this process, which is actually building up my margin period of risk. See this valuation or a margin call. How much time I am really taking, different timelines overall adding up to the margin period of risk. The first thing is the valuation, the margin call giving process. How much time I am really taking to compute the current exposure? Right? What is the mark to market value of the current exposure? What is the current market value of the collateral? So these two are very much required, because in our formula, if we have seen, threshold could be a constant. But apart from that, I need to know what is the mark to market value of my exposure V, and I also need to know the C, what is the market value of the collateral. So there is some time that goes into the computation. Along with that, there could be a contractual period between the margin calls. The counterparties might have, as a part of their CVA, as a part of their CSA, credit support annex, they must have very clearly defined the contractual period between the margin calls. Let's say 1 day. So that 1 day minimum I have to wait before I give a call. So even that time delay also need to be considered. So there is some amount of time that is adding up to the margin period of risk. Then receiving the collateral, there is a delay. The counterparty getting a request, please deposit the collateral, to the time the party is making an arrangement to release the collateral physically. And in some cases, there could be a dispute over the amount, depending on how the valuation has been performed, what are the important input data that are considered for performing the calculation. Depending on various aspects, there could be a dispute, which means a proper resolution of the dispute, the timeline for resolving the dispute, even these things will increase my margin period of risk. Then there is a settlement part. Depending on the kind of collateral that is given, there is a settlement. Probably if I have to raise the fund from somewhere and deposit the collateral, cash is settled more on an intraday basis, but any other collateral, let's say they are the bonds, they may take around 1 to 3 working days for times of settlement. So which means there is some amount of delay which is adding up to the margin period of risk depending on what liquid or illiquid kind of assets I am keeping as a collateral. There is a time delay there. Then there is a grace period. Okay, I have asked for a collateral. My counterparty did not provide a valid collateral. Again, there could be a process where I can go back and request for a better collateral. But if it is not received also, I cannot directly say that the counterparty is default. There is a grace period which is there before which I can talk about this counterparty is in default. And towards the end, I should be able to liquidate it, sell off the collateral, convert it into cash, re-hedge the position. Even there is a time for that. So all these really add up to the time, which is what is being looked at as the margin period of risk. And the entire assessment, whatever the calculation and the modeling of the exposure under the assumption of margin period of risk, it has to be performed making a very serious assumption that the counterparty is defaulting and the market movements are very much far away from the normal, because in a regular scenario very rare the counterparty will default, very rare that the collateral will be used. So all this model has to really take into consideration the scenarios where the market conditions are far away from being normal, and the time that is taken, right, time before being able to take the delivery of a collateral after a valid call, it is very high. And even the Basel II rules say the margin period of risk for the OTC derivatives is somewhere on a minimum period of margin is around 10 days under the assumption that you are going for the collateral be called on a daily basis. So I have to make sure that I have to make an accommodation for 10 days. And OTC, it is separate for OTC derivatives as well as the repos. In general, we see for the repos the number is around 5 days. So because the collateralization is much tighter in case of repo, and in some cases this can be very much longer also based on the collateral agreement and the credit worthiness of the counterparty. So whenever we are looking at collateral, right, the threshold, first thing, it is majorly capping the exposure around the threshold only. The more and more reason for having a threshold is, you see that to a large extent the exposure will vary around the threshold itself, and that too we see that it would be much little at the beginning and the end, only where the initial exposures are much lesser. In that case collateral does not have any kind of an effect, but even towards the end of even there also collateral has little effect. And I have to really look at the number of days that I am taking to literally receive the collateral, which is the delay part. And a few other things that have to be considered are the posting of the collaterals, MTAs, all these things. Now if you see here, just a simple example, let's say this is my portfolio. Without the collateral, what are my exposures here? 25, 15, 5, 0, 0. So the expected exposure here for me is 20, 25, 45. So the expected is 9. But look at that, for this, let's say I have posted, or probably I have received a collateral of 23. I have received a collateral of 12. I have received a collateral of 3. I have received a collateral of -2. I have received a collateral of -18. This is where the significance is. Okay, here fine. My with collateral, the exposure is 2. With collateral, the net exposure is 3. With collateral, the net exposure is 2. With collateral, still the net exposure is -3, so I can omit. Here, with the exposure, the net exposure with collateral, the net exposure is +3. So overall, it is 2 the expected exposure, but this is a very important point. Here, I am having a collateral worth -18. So I'm supposed to pay 18 bucks as a part of the collateral. So overall my exposure is to the extent of plus 3 here, because the expected, the future value is minus 15, but minus 18 is the collateral is as good as I have deposited a collateral worth 18. If I have deposited a collateral worth 18 and my exposure is only 15 there, I have actually paid, my collateral is over collateralized. The collateral which I have deposited is for a very high value. So that is the amount also which I am going to lose in case the counterparty default. Now this is where I have to be very much comfortable, not just paying the collateral, not just receiving the collateral. Even in terms of paying the collaterals, I have to be very careful of, because they can very much increase my exposure. As we have seen in scenario 5, the collateral which I have given is actually increasing my exposure also. And in many cases of repos, we see repo is nothing but a collateralized loan, and we see from a reverse repo perspective, the person who has actually given the loan, right? Because he is taking the security and giving cash. So it's as good as a person, he has given a loan by taking something as a security. So for him, the exposure is to the extent of either he will receive cash value minus the bond value. Because he has already given some kind of cash, he has got the bond. So his exposure is to the extent of the difference between the two or zero. So the maximum of these two. And in many cases, to protect himself, the collateral is generally gone with a haircut. And we are seeing here, as the haircut is increasing, this is a scenario with a haircut of 0.25, this is with a haircut of 0.5%, and this is with a 0.75. The higher is the haircut that is being put, the projected or the potential future exposure is going lower and lower. The counterparty risk is becoming smaller and smaller. Right? Even the variation margin, which is like a reset, even that can very much reduce the impact of the changes that are coming in the bond prices. So that's how in case of repos, the more and more over collateralization that is being done, it can very well reduce the counterparty risk. So the exposures will go almost zero by doing this over collateralization, which is very much comfortable with respect to the repo transactions. So overall, we have looked at how much is the collateral, what is the margin period of risk, what is the impact of collateral on the exposure, and what is the over collateralization that happens with respect to repo transactions. Alright. Now, let's try to understand how we choose between the risk neutral probability calculations versus the real world probability calculations with respect to the pricing world, in which case I have to use what? With respect to the risk management, with respect to exposure computation, where in what scenarios, what kind of probability measures, and what are the differences between the two. So that's where we would focus more on the importance of the measure, and how does these things like drift, volatility, and correlations play an important role in the decision of the same. See, generally, few bullet points for keeping in mind. The pricing world always uses a risk neutral approach. Risk neutral, just for a definition perspective, risk neutral is something which is derived from the markets. The probability is derived from the market. It is not observed in the historical data. Whereas the real world approach always is picking the data from the historical, which is like in reality. So there could be a kind of difference between the probability whether it is default probability or any probability that we are bringing in, one calibrating it. So this is a calibrated one. One calibrating it from the markets, whereas the other one is purely observed from the real world data. And the risk management related, which is finding out the potential future exposures and all, they require the usage of the real world probability, whereas the pricing of the securities, like the computation of the credit value assessment, CVA, or the hedging aspect, they go with the risk neutral approach, right? So whenever we are deciding between these two, for any particular market variable, I have to look at the three different dimensions of the market variable. Drift. Drift is more associated with the average change, mean change. Volatility is associated with the standard deviation. So is the volatility of that particular variable changing constantly? And the third dimension is correlation. Is the correlation between the two variables, co-movement between the two variables, is that changing dynamically? And many a times the drifts, if at all they are market, from the pricing perspective you look at, they are all market implied, which means when I'm taking them from the market, I really don't require the real world distributions for them. And a few more considerations we have to do. The mean reversion. There are a lot of variables in the market, probably the interest rates. They exhibit a mean reversion behavior. If they have gone up, they are supposed to come back. They can't be up and up and up forever. If they have down, they have to again come back to some average level, long-term average level. So this is where some of the variables will definitely exhibit a mean reversion behavior over time. So for those kind of market variables, probably even if I don't observe the real world data, or I could see that in the historical, from the historical also, they may come back to a long-term average level. But when I am doing it from a risk neutral perspective for them, the calculations will be much smaller. Mean reversions will not happen that long for that longer a period. Mean reversions are in a very smaller range. But if I am taking them from the historical data, I may see that the mean reversion range could be much lower. Sorry, much higher. Now this is where we have to differentiate what kind of measure I would be using in what situation. So, okay, let's look at one by one. Drift. If I'm talking of very short-term market risk, drift hardly matters. Drift is the mean change, the average change in the variable. The average change in the variable, probably if I'm talking about an interest rate change, or if I'm talking about a price change, hardly. I don't need to think of that price change from 1 day to 10 days, it would be significant. But if I'm looking at for a 1 year period, there could be a drift. There could be on an average change. So for short-term market risk assessment, for the underlying asset, the drift is not that important. But the same if I look at for long-term risk assessments, drift is very important. So depending on whether I'm doing the risk assessment for long-term or short-term security, I will think of whether I should use the drift component or not. And to a large extent, the drift is not observed from the market data. We use the risk neutral parameters itself. We generally compute the average shift based on the forward rates. And we have to understand, especially if the time is very long, we see that the drift is more and more linearly varying with time. Whereas the volatility, we see that it varies with the square root of time. So drift will become more and more significant as time passes drastically. If the time period is much longer. And for a few instruments, let's say like commodities, the storage costs, inventory, seasonality. Now, because of all these things, we see that, see, logically, when I'm going with the risk neutral, the futures price should be the spot price into some kind of time interval. Now, futures price should be some function of the spot price. But in many cases, let's say for this commodities kind of stuff, there are storage costs, okay, and there are inventory, seasonal effects, which means these two may not be equal at all. In some cases, it could be much higher. So the future price is greater than the spot price, which is what we call as a market of contango. And when we see that the future price is much lesser than the expected spot price, we look at it as a backwardation. Now, in reality, the market could be either here or here, right? Which means that that's again a point of contention here. The market could be either here or here, but both of them are very rarely the same, which means the drift is very difficult to find out. Whatever the drift that I am finding out, that may not be, that is generally under the assumption that these two are equal. But if these two are not equal, then again there is something else that I may have to bring into picture. The interest rate similarly. The yield curve is either sloping upward or downward. We know the different term structures of interest rates. The theory is guiding the term structures of the interest rates. They can be either going upward or downward. And at the same time, how the market perceives, okay, within the next 1 year, are the interest rates, short-term interest rates expected to go up or go down? So which means the yield curve will be changing consistently. Similarly, the credit spreads, in some cases they could be increasing, in some cases they could be decreasing, depending on the availability of the credit or depending on the default probability. Is it expected to go up or go down in the future? Like this, for a lot of instruments, the forward rates may not be directly represented from the spot rates. So which means the risk neutral approach of doing the assessment of the parameters, especially with the drift, it's not that easy a process, right? Majority, but still, even though the markets are imperfect, and even though that we know that we cannot always expect the current future price to be the best estimate of spot price, we still see the most of the CVA calculations and the PFP calculation. So PFP calculation is the risk management calculation. CVA calculation is the pricing calculation. They are all depending on the forward rates. They calibrate the forward rates itself to finally compute the drift. So the drift is generally from a risk neutral, calculated from a risk neutral approach, whereas it's not that done from a real world probability approach. Whereas when it comes to volatility, to a large extent, I see the historical estimation of the volatility. So whenever I am taking the historical estimate of the volatility, we are making a blind assumption there that the past will be a good indication of the future. But in this case, past, how much past? 1 year, 1 month, 3 months, 12 months, what is it? So deciding on the time period is very much essential. But of course, it has its own set of drawbacks. Because when we are observing that historical period to be a quiet period, we see that the volatility would be much lesser. Whereas if we are looking at highly fluctuating last 1 year, then I see that the volatility would be much higher. And that volatility will give me a very high number for my risks. So I have to really see what should be the time period that needs to be considered. Similarly, the volatility is having a mean reversion behavior. So if the volatility has gone too high for some time, it cannot keep going high. It has to come back to some long-term average level. So which means if the mean reversion is existing in many of the prices, the moment mean reversion exists, the volatilities are going to come down. Because the price is not going up and up like this, it is coming here. So the mean will lie somewhere between this, which means the volatility is coming down. And so in some cases, people think of using an implied volatility, which is a risk neutral approach, where the calibration happens from the market, but in some cases, it is expected to produce an upward bias. Because it's a market, so the market pricing of risk always contains some kind of risk premium based on whatever. There are different things that add up to the risk premium. It need not be a direct reflection of the probability of default. There could be a liquidity related issue. There could be a default premium. There could be many other premiums that can get added up, which means the risk premium also is included, which is resulting in an upward bias. So that's one of the prime reasons the risk neutral probability sometimes may not be considered. So generally from a volatility perspective, the preference is more for going with a real world probability approach rather than a risk neutral one. And in case of correlation, the confusing aspect always is it's not that easy for us to know whether a high or a low value is more conservative. So, which means it's very difficult to rely on the market implied parameters. So, obviously, it's not suggested to go with a risk neutral pricing approach for obtaining the correlation, because the resulting risk numbers would be conservatively high when I am going with the market neutral, risk neutral kind of an approach. And but what is very much expected out of correlation is come out with the wrong variance. What is the kind of correlation that exists between the default of the counterparty and the collateral that has been posted against that default? So to a large extent, we rely on the data from the historical sources itself, which means the real world is a better estimate or better choice for estimating the correlation between the events. So just to summarize, the real world is much appropriate both for volatilities as well as correlation, whereas risk neutral is the suggested approach for arriving at the drift. Though I can use real world also, but the risk neutral is more and more appropriate for the drift. So that is what we just wanted to understand the importance of measure, the drift, the volatility, and the correlations per se. All right.